In this lecture, we will discuss behavior finance and investment decisions. Here is the outline for today. We will first introduce what behavior finance is, and then we'll discuss efficient market hypothesis, which is the foundation of the conventional finance theory. And then we'll talk about some challenges of market efficiency, and that is actually the fundamental reason why we need to study behavior finance. Right? So what is behavior finance? Finance is concerned with the allocation of assets and liabilities over space and time, often under conditions of risk and uncertainty. Right? So that's why decision under risk and intertemporal decisions are actually the foundation of studying financial decision making. Finance is also referred to as the art of money management. In contrast, behavior finance is a subfield of finance. It studies how the psychology would affect financial decision making and markets. Conventional finance studies how individuals and the market should behave, assuming people are rational. So just as the neoclassical economic theory, finance is built on the assumption of rationality. In other words, it's built on rational choice model. Right? So conventional finance is prescriptive theory, meaning that it's prescribed what rational people should behave. Well, behavior finance studies how individuals and the market actually behave, meeting various psychological influences. So behavior finance is so-called descriptive. It describes what people actually do in financial decision making. So to motivate our understanding of behavior finance, let me ask you a question. Suppose you encounter the following situation, and you see a 20-euro bill lying on the ground. And what would you do in that case? This seems to be a dumb question. Of course, if you see a 20-euro bill, you go ahead and pick it up. But if you are a firm believer of conventional financial theory, as conventional financial economist, you would not bother to pick up the 20-euro bill. Why is that the case? Because if you assume people are rational, that bill you saw must be counterfeit, because real money must have been picked up a long time ago. So there will be no chance for a real 20-euro bill laying on the ground without anyone picking it up. Right? So that means if you assume rationality of people, as conventional finance theory assumes, then there should not be 20-euro bill on the ground, so you would not bother picking it up. Right? Now you may find out that it is bizarre to have this kind of assumption. Right? That is why we want to study behavior finance, to bring some realism to the theory of finance. Here is another reason we want to study behavior finance in a course on behavior economics. There are some common criticisms on behavior economics. You know that most of the regularities that we discuss in this course are based on lab experiment, where participants are recruited to the computer lab and make decisions, and then we investigate their behavior. The criticisms on those lab experiments is that in those lab experiments, the stakes are small and the environment are usually artificial, and also the subjects do not have enough time to learn from their experience. Right? Whether these criticisms are valid or not, you can make your own judgment. Personally, I don't think those criticisms are valid. First, not a lot of decisions made in real life have big stakes, and a lot of decisions we make in our lives, we do not make it repeatedly. We only make the decisions once or twice. Right? So, for example, purchasing a house. That's some decisions you only made maybe once or twice in your lifetime, and you do not have enough experience to learn from. Just assuming those criticisms are valid. Financial decision making in financial market usually involve high stakes and ample opportunities for professional traders to exploit the mistakes made by others. And because of this, misbehaving or biases in financial market is least likely, right? Because all those investors who make serious mistakes, they will be rid off in the financial market. They will go broke very easily. So if behavioral anomalies are found in financial market, it shows that behavioral anomalies cannot be disregarded. And that is actually the case. So another reason we want to study behavioral finance is because the behavioral anomalies observed in the financial market lend strong support for behavior economic theory. So that's what behavior finance is and why we need to study behavior finance. Now let's just get to the core of finance, one important hypothesis that is directly derived from the basic assumption in the theory of finance, rational choice theory. Right? So that is the hypothesis of efficient market. Right? Before introducing efficient market hypothesis, let me ask you one hypothetical question. Suppose you follow closely the news on Carlsberg and know that this morning its earning is shown to be much higher than expected. Should you consider purchase more of its stocks? Your answer may be yes or no. And if you are a firm believer of efficient market hypothesis, then you would not base your decision on the most recent news on Carlsberg, right? Because efficient market hypothesis assumes that asset prices reflect all available information. Talking about the efficient market hypothesis, it actually has three forms. The weak form is stating that the asset prices already reflect all historical prices and returns. One implication of the weak form of efficient market hypothesis is that you cannot predict the trend of a stock and the price of any asset based on its past prices, because the information of the past historical prices and returns are already reflected in the current asset price. Now, the semi-strong form, meaning that it's already include all public information. One direct implication of the semi-strong form of efficient market hypothesis is that value analysis or fundamental analysis used by Warren Buffett, for example, and all the other value investors would not bring you additional returns because all the public information, including the financial report of the corresponding firms, are already incorporated in the asset price. So in semi-strong form of efficient market hypothesis, anyone cannot beat the market with analysis of any kinds of information. And the strongest form of efficient market hypothesis is that the current price of the corresponding stocks and other assets already reflect all information, even including the private information. So the semi-strong form saying that asset prices already incorporate all public information, and the strong form, it says the asset price not only incorporated all public information, it also has already incorporated all the private information. The two components of efficient market hypothesis, or two implications of efficient market hypothesis, is that there's no free lunch, meaning that it's quite difficult, close to impossible to beat the market. And also the price of any asset is right in the sense that asset prices are already equal to the corresponding intrinsic value. In an efficient market, no investors can consistently earn excess returns without taking on extraordinary risks. That means you should not act on good or bad news of a company, because when you decide to buy or sell its stocks, the news has already been taken. Because when you decide to, you should not act on good or bad news of a company, because when you decide to buy or sell its stocks based on the news has already been reflected in its price, meaning that you will not be able to exploit the new information. So based on the assumptions and descriptions of efficient market hypothesis, my question for you now to think is, do you think efficient market hypothesis is an accurate description of the financial market? Right? Think about it. Now let's give you some evidence that is supporting or refuting the efficient market hypothesis. This is the stock price right before and after the Federal Open Market Committee press release. If you understand the structure of the Federal Reserves in the United States, you know that those committees usually come together to have discussion and decide whether they will make changes to the corresponding interest rate. And we also know that interest rate has a great influence on the asset price, especially stock price. And the press was released around 2 p.m. And you see here, it took only milliseconds for information to be reflected in the stock price. So this seems to be indicating that the corresponding information released by the FOMC can be immediately incorporated in the stock price. It's some evidence supporting the efficient market hypothesis. Right? Here is another example. This figure shows the S&P Standard & Poor 500 futures market on Tuesday morning, September 11, 2001. If you know a little bit about history, you know what occurs on the 11th of September 2001. Right? So there's a plane crash on the Twin Towers in New York City. Because it occurs before the opening of the stock market, so we will not be able to observe its influence on the stock market price in real time. But the futures market opened before the stock market, so we could observe its influence on the futures market, right? So futures market, you can consider that as a prediction of the corresponding stock prices. So here we see that around 8 o'clock, 47 minutes, that's when the first plane crashed into the North Tower, right? So immediately after the crash, even though not everyone know what was going on, we already observed some decrease in the futures market price, right? And it's recovered immediately, but we do see this decreasing trend over time. And then after 9 o'clock, the second plane crashed into the South Tower, and we see this dramatic decrease. Right? Again, just within minutes, we see the market. Here is the futures market already incorporate the corresponding information of the plane crash into the futures market, right? Into the asset price. Now, here is again another example. Can the collective knowledge of all traders contribute to more accurate evaluation and forecast, right? So there are all kinds of forecast market. Iowa University of Iowa actually have this trading market that you can predict all kinds of events, and depending on the outcome of the events, and you can get some returns. If you have a great and accurate prediction, you can reap the gain from making the prescription, right? And here is the kind of prediction market that predicts the result of presidential election. So we see that early in the election, when the votes are being counted, the success rate of Donald Trump is actually slightly lower than Kamala Harris, right? But eventually, as the corresponding information incorporated into the prediction, so more counts are released and more states would finalize the corresponding counts, deciding who's the winner in the corresponding state. We observe the evolution in the change of the success rate. If you pay attention to the stock market, Tesla observe a dramatic overnight increase right before the results of the presidential election was released, because you know that Elon Musk, the CEO of Tesla, has a strong support of Donald Trump, and people predict that if Donald Trump win the election, it's good news to Tesla, and it will bring benefit to the company. Right? So we see that the corresponding information has already, and in a short period of time, to be incorporated in both the prediction market and also the corresponding stock price of the related companies. Right? So as the last example, I will talk about the Challenger crash, and that provide evidence that information. And the last case I want to discuss is the Challenger crash that provide evidence that the corresponding information can be quickly incorporated in the stock price, even the private information. Right? So if you again know some of the history, this Challenger, this space shuttle, got exploded at 11:39 a.m. on January 28th in the year of 1986. The announcement came across Dow Jones Newswire at 11:47 a.m. And we would expect that the Challenger crash would not have a great influence on the stock market overall, right? But it could influence the stock prices of the corresponding suppliers or the makers of the Challenger space shuttle. Right? 4 major contractors participated in the Challenger launch. Right? The issue was identified by the Presidential Commission 6 months later. Now, let's look at the corresponding stock price of the 4 companies who are the major contractor participate in the Challenger launch, right? So we have this Morton Thiokol, Lockheed, Martin Marietta, and Rockwell Internationals, right? So on January the 28th, that is just right after the crash, we observe consistent drop in the stock market price. So it's interesting to see that Morton Thiokol has dramatically decreased its price compared to the other 3 contractors. So it seems that the public knows something, right? So even though the real reason causing the crash was not identified, some private information about the cause of the crash has already been incorporated into the stock price. So based on the change in the stock price of the different companies, we suspect that if you believe that private information has already been incorporated into the stock price, we can suspect or predict that Morton Thiokol is the contractor that is responsible for the issue, right? And here is the corresponding price relatively to opening price, right? So we see that all 4 major contractors has observed some decrease in their stock market price. But we do observe the MT, the Morton Thiokol, has observed a more dramatic decrease. Right? So in the morning, after this news released, this crash, we see the drop. But during the close times, we see Morton Thiokol has a dramatic decrease. It's decreased for more than 10%, close to 12%. And here is the stock market price in the following month after the crash. So for the other 3 contractors, so after the day and within a month, it's not only recovered to its pre-crash level, it's also observed a great increase. And the Morton Thiokol, which later was identified as the main cause of the issue, its stock market price after a month has not recovered to its pre-crash level, right? And it's indeed demonstrating that the private information, who knows who's more likely to be responsible for the crash, is already incorporated in the corresponding stock market price. Right? So a strong piece of evidence, again, supporting efficient market hypothesis, right? So the information, once it's released, sometimes even private information, can be quickly incorporated into the corresponding asset prices. So the previous examples that we have seen provide evidence that new information can be immediately reflected in the stock market price. It could be in a matter of seconds or milliseconds, especially if information release time is known beforehand, like the release of the information from the Fed, whether there will be an increase or decrease in the interest rate, right? So we know at what exactly time the corresponding information is released. A lot of people will be waiting for that information. So in that situation, in milliseconds, the corresponding information, the market can respond to that piece of information. Studies of financial market provide evidence, however, on lagged reaction and effective trading rules to beat the market. So that means even though we have evidence that information can be incorporated into the stock market price immediately, we do observe some lagged reaction, right? So even though, some investors can immediately react to the release of news, it does not prevent a lot of other investors who are not attentive to the news to react it at a later time. So because of this, the lagged reaction could be contradicting the corresponding efficient market hypothesis. Right? Now, let's just move to the next topic, the challenges to market efficiency. Even though we have learned that information can be incorporated immediately, this incorporation is not full scale. Some investors would react to the new information, to the public information, but a lot of investors, they are slow in reacting, making the opportunities to gain from reacting to the corresponding information, right? So that's is a contradiction to efficient market hypothesis. Now let's just summarize the evidence against the efficient market hypothesis. In order to do that, I need to introduce one type of study that can give us a measure on how quickly people respond to the new release of information, which is called event study. The effect of an event on earnings can be studied using the event study methodology. The essence of event study is first look at a number of similar events. For example, we could consider the event of earnings announcement. And this similar events for a comprehensive sample of firms. Right? So we don't look at just one firm, we look like a large sample of firms. And then we calculate the excess returns. It is the residual returns over the market return, right? We calculate those excess returns over time before and after the event. And then we accumulate the average residual to obtain this cumulative average residuals. So from investigating the cumulative average residuals over time, we can have a sense on how the market react to the corresponding event, right? In this case, it could be the earnings announcement. Here is an illustration. The x-axis represents the days from earnings announcement. On the y-axis, it represents the cumulative average excess returns, which we have defined before. Right? The daily return data around quarterly earnings announcement of about 100 firms are summarized in this graph, and the corresponding returns are across 8 years from 1972 to 1980. And firms are divided into 10 groups based on their unexpected earnings, whether the announced earnings are better than expected and whether their earnings are worse than expected. Based on the difference between the expected earning and the actual earning, we divided the firms into 10 groups. So the group 10, meaning that the earnings are unexpected good, right? So it's much better compared to the corresponding expectation. And for group 1, the lowest the decile is represent the firms where the actual earnings are much lower than expected earning. So as we can see here on day 0, that is the day where this earnings information is released, we see an immediate reaction to the news, right? So market anticipated the surprise in earnings and react quickly after the announcement. So we see that this reaction is actually before for a lot of the firm is before this actual announcement and immediately on the date. So some of the investors, they probably have some private information already before the release of information, and they already react to the information. Right? And on the date, that is where the reaction is most dramatic. However, we do observe a continued drift in price that is contradicting with the efficient market hypothesis. So after 3 months of time, right, on day 90, we still see that the top decile of the firms still observe an increase in their price. And for the worst group of firm, their stock price is still decreasing. So this represents a lagged reaction of earnings announcement. So even though the market would react to the new information immediately, but we do see that the market as a whole would have this lagged reaction. Right? So this is contradicting with efficient market hypothesis. So now that's first piece of evidence against efficient market hypothesis. Now let me ask you several questions about investment and to check whether you have some intuitions on the strategies that you could use to exploit the market to gain excess return. Right? So here is the first question. You can choose a portfolio with small firm stocks and a portfolio with large firm stocks. Which portfolio do you expect to bring you a higher return? So think about this. Later, we'll present some evidence. The second question, you can choose a portfolio of stocks with low PE ratio and a portfolio of stock with high PE ratio. Which portfolio do you expect to bring your higher return? Right? We have introduced the concept of a PE ratio when we introduce asset bubble. PE ratio meaning that this stock price divided by the earnings. It represents how cheap the stocks are relative to its earnings. And it can be understood as how many years it takes for you to get back to your investment. So now try to think about whether you would choose low PE ratio portfolio or high PE ratio portfolio. Now the third question. One portfolio includes stocks with higher than average returns in the past 3 months. We call those portfolio as past winners. And the other portfolio includes stocks with lower than average returns in the past 3 months. We call those stocks as past losers. Which portfolio would bring you a higher return? In other words, which portfolio would you invest so that you can earn the return higher than the market return? Think about this. And next, a related question, very similar question, but the time span that you are considering is different from the previous one. One portfolio includes stocks with higher than average returns in the past 3 years. We call those stocks as past winners. And the other portfolio includes stocks with lower than average returns in the past 3 years. We call those past losers. Which portfolio bring you a higher return? Now, let me introduce some trading rules that have shown to be effective in the past to bring you a return higher than the market return. Past data have shown that some trading rules can bring excessive returns, posing challenges to market efficiency. So first one, when we compare small cap portfolios, cap meaning market capitalization, right? So small cap portfolios meaning it's a portfolio with companies that are small in size. And then we have large cap portfolios. Which one do you think would bring you a higher return? Well, past data has demonstrated that small cap would win out. And then portfolios formed based on PE ratios. Do you think low PE ratios would indicate better returns or high PE ratios? The past data says low PE ratios would do better. Now, recent winners versus recent losers in terms of winning, in terms of earnings, which type of portfolio would be better? Well, as the two questions asked before, you might expect that which portfolio performed better depends on the time span. Right? It turns out that based on past data, again, reaction to extreme announcement is slow. Right? So past winners is likely to continue to be the winners in the 3 to 12 months. But in the long run, there would be some mean regression, right? So reversion to the average return. So past winners are likely to continue to be winners in the following 3 to 12 months, but over 3 years, for example, right? More than 1 year. Over a longer period of time, we would expect that on average, past losers would win in terms of returns. Right? So past winners are likely to continue to be the winners in the short period of time because of the lagged reaction to the news announcement, as we discussed before. But in the long run, right, it may be higher. The price will be higher than the intrinsic value, so it will just go back, have this reversion to the intrinsic value. Now, let's look at the evidence. So first one, small cap portfolios would earn a higher return, right? So here are the returns on size decile of US stocks from the year 1926 to 2012, right? So here we have different sizes from the smallest portfolio to the largest company, the portfolio of largest company. And we see that the smallest portfolio would give you a return of 17% return. Right? And the largest portfolio would give you less than 10%. So that indicate this advantage of having a small cap portfolio, right? According to the efficient market hypothesis, this difference should not be there, right? But we could exploit this pattern to make excess return. And here is another figure demonstrating this difference. So on the x-axis, again, we have 10 deciles of portfolios based on the size of the firms. Right? So we have the smallest firms to the largest firms. And we see a clear trend as we increase the size of the firms, we have a lower return. Now that's the first observation. Based on past data, small firms usually perform better compared to large firms. Now, the decision rule based on PE ratio. There are names for the low PE ratio stocks and high PE ratio stocks. Right? We call them value stocks versus growth stocks. Right? Value stocks are the stocks whose price are low relative to accounting measures. The accounting measures could be earning, which leads to this PE ratio measure. It could also be other accounting measures like cash flow or book values. Right? On the other hand, growth stocks are also called glamour stocks, are stocks whose price are high relative to accounting measures. Right? Why then the corresponding stocks are expensive? It's because the market would anticipate a high future return, high growth in the future, and that's why it's called growth stocks. Value stocks can be considered as cheap relative to their accounting measures. So accounting measures could lead to a PE ratio or BP ratio. Right? So BP ratio is the book to market price ratio. And the book value of the corresponding company is the market capitalization of the firm. Right? So when we have BP ratio, we use the market capitalization divided by the price. Right? Now, let's take a look at some examples. Right? So here we have growth, valuation, and returns to IBMs and Standard Oil in New Jersey from the year of 1950 to 2012. IBM. So here are the growth measures like revenue per share, dividend per share, earnings per share, and sector growth, right? So here we see that in terms of revenue per share, dividends per share, earnings per share, IBM outperforms Standard Oil of New Jersey. right? So that means IBM has an advantage over Standard Oil in its company level performance and even the sector level growth. For Standard Oil of New Jersey, it observed a shrink of the sector, while IBM also observed a growth in the whole sector. So in terms of growth, IBM definitely outperformed Standard Oil of New Jersey. Now let's look at valuation measure. So here it includes price appreciation, dividend return, and total return. Right? So in terms of price appreciation, we observe IBM have a higher growth in its price. But dividend return and total return, Standard Oil of New Jersey outperforms, has a better performance. If we look at the return measures, right, so we have a much better performance of Standard Oil, which is a value stock in terms of the PE ratio compared to IBM, right, which is a growth stock, right? So people would expect IBM to have a better future. I mean, it probably indeed have a better future in terms of growth, right? and corresponding dividends and earnings. But at the same time, it's overvalued because of the expectation of future growth. Maybe people are too optimistic about the futures of IBM, right? So let's look at the return measures. So here, the first one is the average price earning ratio. We see that IBM has 25 PE ratio and Standard Oil has 14, meaning in terms of this price and accounting measure ratio, IBM is worse, right? So it's more expensive. And it's also indicated by the average dividend yield, right? So IBM only provides 2.17%, while Standard Oil provide 4.21%. So all in all, if you look at whether the investment in either stock is better than the other, Standard Oil of New Jersey is definitely a winner, right? If you invested $1,000 in the oil giant, Standard Oil in New Jersey, so it will be worth $1.62 million. So more than twice as much as IBM. So this is demonstrated just one single example. Of course, one case study does not say about the general trend, but it's a good demonstration. Now we look at the stock price. Now we look at the differences in returns of the value stocks and the growth stocks on the aggregate level, right? So here we divide all the stocks in S&P 500 based on their PE ratio, right? So the lowest PE ratio to the highest PE ratio, right? With 5 different groups. And we see here the returns to the low PE ratio is significantly higher than the returns of the stock with high PE ratio, right? So for the lowest PE ratio portfolio, the returns on average, the average annual returns is close to 13%, while for the highest PE ratio stocks, it's less than 8%, right? So it's almost double. And here is another figure demonstrating or telling the same story. Here we divide the portfolios of different companies based on PE ratio into 10 different groups and calculate the corresponding annual returns. And again, in this, if we divide it in the portfolios, the stocks into 10 groups rather than 5 groups, we see the difference is even more dramatic, right? So the top performing group with the lowest PE ratio, provide a return of 16% each year, right? So this data is from 1990s to early 2010s, right? And the highest PE ratio group only provide a return less than 7%, right? So now the best performing group provide more than twice as much as the return of the worst performing group. And the previous 2 slides are based on the stock market in the United States. So these conclusions is not limited to US stock market, right? So we also have this performance across the globe, right? So here in the following 5 countries, we observe the portfolio performance difference between value versus growth stocks, right, in various countries. So here we see the corresponding portfolio performance in percentage points. For value stocks is shown here. The growth stock is shown here. And we see across all the 5 countries, the corresponding returns are significantly higher, either measured by book price level or earning price level, or earning price ratio, or book price ratio. So again, so here is a strong piece of evidence saying that there is some arbitrage opportunity for you to exploit the market so that you are able to have excess return compared to the market return, which is just looking at the P ratio or the BP ratio to determine whether the stocks are overvalued or not. And then we make our investment decisions accordingly. And then we can actually outperform the market. And again, I want to emphasize, and later we'll emphasize again, these patterns are based on past data, past experience, right? So in the future, whether it holds or not, we don't know. And we will have elaboration on this. The last trading strategy that we can use is the so-called momentum strategy. Here is a table that demonstrates the returns in each after several months of different portfolios. And we can observe that the winner stocks are likely to keep winning in the intermediate terms. That is from 3 months to 12 months. Right? And here, let's look at this test period and the formation period, and let's just try to understand how to read this corresponding table. Right? In the following table, it shows the correlation of returns in the past versus returns in the future. Right? So that's an intuitive way to understand the following table. The way to conduct this analysis is to calculate the returns of one stock across different time period in the past, that is in the formation period, and in the future, that is the test period. And we calculate the correlation between the returns of this different period. For example, the formation period 3 and the test period 3 is that we first calculate in the formation period of the 3 months, what is the corresponding return, and then we calculate the returns of the following 3 months, and we calculate the correlation, and we see the correlation is positive, right? So we can also calculate the 3 months return in the formation period and the 6 or 9 or 12 months return in the following period. So by calculating the correlation of the formation period and the test period, we are able to identify this momentum. And we see that across all different time period or time span, we are able to observe the positive correlation. So that is indicating this momentum strategy could work in the intermediate term, right? In 3 to 12 months. I mean, based on previous slide, we can understand this as evidence of lagged reaction because people take some time to react to the news. So we observe in the intermediate term this momentum. But if we extend our scope to longer time horizon, the corresponding evidence will be different. So here is a study that shown the corresponding cumulative average returns for winners and losers portfolio of 35 stocks over 5 years span. Right? So that is 60 months. And over the time horizon of 3 to 5 years, we actually observe some performance reversal, right? So that means this momentum strategy existed in the past data, but depending on the time horizon that we are looking at, it either follow the previous trend in the short or to intermediate terms, and also it could reverse and have the reversal if we look at longer period of time. So these are the 3 major trading strategies that we have discussed. And all of these are contradicting with the efficient market hypothesis. So let's summarize this, right? Portfolios of stocks with small market capitalization, lower PE ratios, and past winners can outperform the market. This effective trading strategy and trading rules contradict efficient market hypothesis. If the market is efficient, then the above-mentioned information should be already reflected in the market price. That means we are not able to employ this trading strategy to earn a higher return than the market return. Effective trading rules imply the market price is not right, leading to arbitrage opportunity. And it is important that arbitrage, meaning using those effective strategies that worked in the past, will correct the market price. Okay? So now let me elaborate on the relationship between market efficiency and arbitrage. Market efficiency implies no or little arbitrage opportunity. And if there are price errors, can be caused by irrational investors or some behavior biases of those investors, the smart money traders can arbitrage them away. However, if you look at the relationship and think deeply about the relationship between market efficiency and arbitrage opportunity, if there are pricing errors, then smart traders would exploit and arbitrage those errors away so that they can gain from it, so that there is no free lunch left on the table, right? So I don't know whether you sense the paradox here. When effective trading rules become well known, then more traders will use those rules and making them less effective. Why is this the case? Because if this trading rules, is effective and well known, everyone would use it. For example, the small cap firms trading rule, right? So if small cap firms prove to be providing higher return, then more investors would actually invest more in small cap versus big cap companies, right? So that would actually drive up the price. And because the price is higher now, you are not able to reap the gain in the future, right? So that is the paradox. When there's a rule proves to be effective, and then more people will start to use that trading rule, and this very act of using the trading rule would make it ineffective, right? So indeed, the small firm effect largely disappeared in recent years, which has been proven to be effective for a long period of time. And it probably because it become well known, people start to use that, it becomes less effective or ineffective. Another famous effect is general effect. It's also largely gone in recent years, right? So here is a demonstration of the cumulative returns for all US firms ranked by the PE ratio. Right? So it's actually, I use the flip of the PE ratio with the EP ratio. The higher of the ratio, meaning that the corresponding stock is overpriced. Right? So this is from the year 1950 to 2021. Right? So if you look at these annual returns of different portfolios, low PE ratio or high EP ratio stocks outperform over the period. But this outperformance or better performance only existed until in the year 2005, right? After the year, it becomes ineffective. So if you look carefully, there may be some reversal of this rule, right? So value stocks had been bought by so many investors that the advantage has probably been arbitraged, all right? Again, thinking about the relationship between efficiency, market efficiency, and arbitrage. Right? So when a rule proves to be effective, more people would use that rule. And that very act of using this trading rule would make this trading rule ineffective. So market efficiency largely depends on active traders exploiting arbitrage opportunity. And that poses the paradox. If everyone believes the market is efficient, then no one will try to discover arbitrage opportunity, leaving the market inefficient. So getting back to our interesting example of this 20 euro bill on the ground, right? If everyone believes the market is efficient, if everyone believes that everyone else is rational, then everyone would assume that there is no $20 euro lying on the ground and no one will pick it up. But in that case, the 20 euro will lie on the ground forever. No one will ever pick it up. Right? So that is the paradox. If everyone believes the market is efficient, then the market will probably become less efficient. Right? So market efficiency would depend on the investors constantly using the corresponding trading rules to exploit the corresponding arbitrage opportunity. Here is a quote that I want to use to end our discussion today. It's a quote by Benjamin Graham, which can be considered as the founding father of value investment and also the teacher of Warren Buffett. Right? A moment's thought will show that there can be no such thing as a scientific prediction of economic events under human control. The very dependability of such a prediction will cause human actions which will invalidate it. Hence, thoughtful chartist is another name for investors who use technical analysis, try to capture the momentum or the patterns of past pricing information. Right? So anyway, hence, thoughtful chartists admit that continued success is dependent upon keeping the successful method known to only a few people. Right? So that's why, right? So a lot of people offer cheap investment advice online on how to pick the most valued stocks. I mean, I never trust those advice because if a trading strategy proves to be effective, you probably don't want to share it with other people because a lot of people knowing the trading rule would make those trading rules less effective or even ineffective, right? So here is just a comment pointing out that investment decision is very difficult. The stock market and financial market is a very complicated environment because people take actions, but they also react to other people. Right? And also, I have mentioned several trading strategies proved to be effective based on past data. But I want to always point out that no amount of sophistication is going to allay the fact that all of your knowledge is all about the past and all your decisions are about the future. Right, so this is a quote from Ian Wilson, the former GE executive. So the reason that I pointing out those trading strategies is just to prove or to let you know that efficient market hypothesis is probably not a valid hypothesis. It's not a good description of the market. It's not to introduce those trading rules because, again, the paradox, right? Trading rules that are used by a lot of people would make those trading rules invalid or inefficient. So to summarize, efficient market hypothesis state that asset prices reflect all available information, so no investor can consistently earn excess returns. But contradicting efficient market hypothesis, past data provide evidence on lag reactions and effective trading rules to beat the market. Also, market efficiency depends on active traders exploring effective trading strategy. But the very act of using and applying those trading strategies make those strategies ineffective. So that is the paradox, right? But efficient market does have its valid point, which is that it's very difficult to beat the market, right? Not impossible, but very difficult. Right? That concludes our discussion today. In case you want to know more about investment decision, here are 3 books that I find quite informative. So the first one is A Random Walk Down Wall Street. The authors is a supporter of efficient market hypothesis. Because it supports efficient market hypothesis, it proposes passive trading strategy, meaning that the best strategy proposed in the book is to invest in index fund. The second book, Stocks for the Long Run, is a thorough analysis of stocks for the past decades, right? Almost from the very start where stock market came into existence to nowadays. A lot of the figures plus that I showed in this lecture are actually from that book, right? So it's provide a good information for you to learn from. The last book, The Most Important Thing, written by Howard Marks, is more on the philosophy of investing. So all these three books would provide different angles in understanding investment decision. The three authors might not agree with each other, but each book provide a unique angle to provide some wisdom for you to understand how to make good investment decision.